In 2008, the world discovered that a single man had managed to deceive banks, billionaires, investment funds, and even charities for decades. More than $65 billion had simply vanished. The man responsible for one of the largest financial frauds in history was not an unknown criminal, and he was not an outsider trying to break into Wall Street. He was one of the most respected men in the entire American financial system. Former chairman of the NASDAQ, manager of billions of dollars in private wealth, a name that almost nobody dared to question. His name was Bernie Madoff, and for more than 30 years, no one realized that everything was a lie. In the world of finance, trust is worth more than money. Banks may have billions in assets. Investment funds may manage enormous fortunes. But in the end, the entire financial system operates on something surprisingly simple: trust. Investors trust that their managers are acting honestly. Banks trust that other institutions are financially sound. And millions of people around the world trust that the system, even with its flaws, fundamentally works. For decades, one man built a reputation so solid that almost nobody dared to question him. His name was Bernie Madoff. To many investors, he was not just a financial manager. He was a symbol of stability on Wall Street, a respected, influential, extremely well-connected, and apparently successful man. For years, investment funds, private banks, billionaire families, and charitable institutions handed him billions of dollars with near absolute confidence. But behind that flawless image, one of the largest financial frauds in modern history was quietly being built. To understand how it happened, we need to go back several decades, long before the financial crisis of 2008, before the investigations, before the arrest, and before the world discovered that billions of dollars had simply never existed. The story begins in a place very far from the towers of Wall Street. Bernie Madoff was born in 1938 in the borough of Queens, New York. His parents were not bankers, investors, or members of the American financial elite. His family belonged to the working middle class, trying to build stability in a city that had always been known for its brutal competitiveness. From an early age, Madoff showed ambition. He was not a financial prodigy in the traditional sense, but he had something that is often even more powerful: social ability. He knew how to talk to people, he knew how to negotiate, and most importantly, he knew how to build trust. During his youth, he worked several jobs to save money. One of them was as a lifeguard on the beaches of Long Island. It was during this period that he began saving small amounts of money. In 1960, with about $5,000 saved, a significant amount for a young man at the time, he decided to open his own investment firm. That decision led to the creation of Bernie Madoff Investment Securities. At first, the operation was extremely small. Nothing like the giant firms that dominated Wall Street. The company mainly worked as a brokerage, connecting buyers and sellers of stocks. It was the kind of business that existed in hundreds of small offices around New York. But Madoff had something many competitors did not: a vision for technology. During the 1960s and early 1970s, much of the financial market still operated with extremely manual processes. Buy and sell orders were recorded on paper, phone calls dominated trading activity, and the speed of transactions was heavily limited. Madoff realized early that the future of finance would be automated. His company began investing in electronic trading systems long before they became standard in the industry. That decision helped his firm grow rapidly. Throughout the 1970s and 1980s, Bernie Madoff Investment Securities became one of the most important firms in what is known as market making, the process of facilitating transactions in the stock market. This meant that whenever someone wanted to buy or sell certain securities, firms like Madoff's helped ensure that the transaction could actually happen. It was an extremely profitable business. Over time, Madoff began building an impressive reputation within the financial industry. He was not seen as an aggressive speculator or a reckless trader. Quite the opposite. He was viewed as someone disciplined, technical, and deeply connected to how the market functioned. His influence grew so much that he eventually held a highly prestigious position: chairman of the NASDAQ. That detail would become extremely important years later. Being chairman of the NASDAQ meant being at the center of the American financial system. It was a position that communicated something very powerful to any investor: legitimacy. To the outside world, it acted as an implicit guarantee that Madoff was not just trustworthy, but practically untouchable within the industry. And it was precisely that reputation that opened the door to the next chapter of his career, a chapter that, for decades, would remain completely invisible to almost everyone on Wall Street. By the 1980s, Bernard Madoff had already achieved something very few professionals on Wall Street ever managed to build: absolute reputation. His firm, Bernard L. Madoff Investment Securities, was known within the financial industry as one of the most efficient companies in processing trading orders. Financial institutions used his services to execute stock market operations with speed and precision. On the outside, everything appeared completely legitimate. But there was a curious detail that began circulating quietly among extremely wealthy investors. Madoff also managed private money. This service was not widely advertised. There were no marketing campaigns, no advertisements in financial newspapers, no public presentations designed to attract investors. In fact, the strategy seemed to work in the opposite direction. Investing with Madoff felt exclusive. In many cases, interested investors were turned away. Others needed to be referred by existing clients. This sense of limited access created something extremely powerful in the financial world: scarcity. And scarcity generates desire. For many wealthy investors, gaining access to the fund managed by Madoff became almost a symbol of status. It felt like joining a private club, reserved only for people who truly had the right connections and enough wealth. What made everything even more impressive was the performance he reported. According to the statements sent to clients, the investments managed by Madoff delivered extraordinarily consistent returns. They were not outrageously high returns that would immediately raise suspicion, and that was precisely the brilliance of the strategy. The reported gains often stayed between 10 and 12% per year, a number high enough to attract investors, but stable enough to appear realistic. Even during periods of turbulence in the financial markets, the reports sent by Madoff continued to show relatively steady gains. For experienced investors, it seemed almost miraculous. Financial markets are naturally volatile. Even the best managers in the world experience negative years or periods of irregular performance. But Madoff's clients rarely saw losses. It was as if he had discovered a secret formula to eliminate market risk. According to Madoff himself, this consistency came from a sophisticated strategy called the split strike conversion. The technique involved purchasing shares of large companies while simultaneously using options to protect the portfolio against market declines. In theory, it made sense. It was a known strategy in the market and used by some managers to reduce risk. But there was a problem. Over time, some analysts began noticing that the results reported by Madoff seemed too good to be true. Even using the strategy he described, it was extremely difficult to mathematically explain how those returns could remain so stable for so many years. Still, very few people dared to question him. Part of this had to do with Madoff's position inside the financial industry. He was not an unknown manager trying to impress investors. He was an established figure, deeply respected and with decades of experience on Wall Street. Another important factor was the type of investor who trusted him with their money. Many clients were extremely wealthy families, private funds, and charitable institutions connected to specific social circles, especially within parts of the Jewish business community in New York and Florida. In that kind of financial environment, trust often moves through social and family networks. If someone respected inside the community said that Madoff was trustworthy, other investors felt comfortable following the same decision. Over the years, billions of dollars began flowing into his investment management operation. But there was something almost no one knew. Despite the image of sophistication and the supposedly complex investment strategy, much of the money was simply not being invested in the market at all. In reality, the system worked in a far simpler and far more dangerous. When new investors deposited money into their accounts, that capital was used to pay withdrawals requested by older clients. In other words, the entire structure depended on a constant inflow of new money to keep operating. This type of system has a well-known name in financial history: a Ponzi scheme. The term comes from Charles Ponzi, a fraudster who became famous in the United States during the 1920s for operating a similar structure. He promised high returns to investors and paid early participants using money from new participants. As long as new investors kept entering the system, everything appeared legitimate. But the mathematics behind this model is brutally simple. At some point, the flow of new deposits slows down, and when that happens, the entire structure begins to collapse. For years, Madoff managed to keep this system running. Part of the reason was the enormous level of trust he had built within the financial industry. Another reason was that many investors were not withdrawing large amounts of money at the same time. In fact, many of them reinvested their apparent profits, believing they were steadily accumulating wealth. That only made the scheme grow larger. According to later investigations conducted by the U.S. Securities and Exchange Commission, billions of dollars circulated inside the system without any real record of market operations capable of generating the results presented to clients. Even so, for decades, almost no one managed to prove that something was wrong. But that does not mean no one tried. During the 1990s and early 2000s, a few professionals began looking more carefully at the numbers reported by Madoff. Among them was a financial analyst who would eventually become a central figure in exposing the fraud. His name was Harry Markopolos, and when he started analyzing the returns reported by Madoff, one conclusion began to emerge almost inevitably. Something there was simply impossible. In the late 1990s, while Bernard Madoff was strengthening his image as one of the most respected investment managers on Wall Street, a financial analyst in Boston began examining his numbers with a very different kind of attention. His name was Harry Markopolos. At the time, Markopolos worked as a portfolio manager at a small firm called Rampart Investment Management. His job was to develop quantitative investment strategies, essentially trying to find mathematically efficient ways to make money in the market. It was the kind of work that required an obsession with numbers, statistical models, simulations, probabilities. Nothing there relied on intuition. Everything had to make mathematical sense. It was in this context that, in 1999, his boss gave him a task that initially sounded simple. He asked Markopolos to analyze the strategy supposedly used by Bernard Madoff. The idea was to try to replicate the extraordinary results that Madoff's fund appeared to be generating. If they could understand how he was doing it, perhaps their own firm could develop a similar strategy. At first, Markopolos assumed the analysis would take weeks. But when he began reviewing the publicly available data, something unusual happened. In his own words, it took about 5 minutes. 5 minutes to realize that something was deeply wrong. The returns reported by Madoff's fund simply did not make sense. It did not matter whether the market was rising or falling. The statements kept showing steady gains, month after month, year after year. For someone working with quantitative models, that was practically impossible. Financial markets do not behave that way. Even the most sophisticated strategies experience fluctuations in performance. Bigger gains in some periods, losses in others. But in Madoff's case, The numbers appeared almost perfect. Markopoulos then decided to examine the strategy Madoff claimed to use, the so-called split strike conversion. As mentioned earlier, this strategy involves purchasing a basket of stocks while simultaneously using call and put options to hedge the portfolio against extreme market movements. In theory, it was a legitimate strategy. But there was a massive problem. When Markopoulos began calculating the volume of trades required to generate the results Madoff was reporting, he arrived at an absurd conclusion. For the strategy to work at the scale Madoff claimed, he would have needed to buy more options contracts than actually existed in the market. This was not a matter of efficiency. It was a mathematical impossibility. In other words, if the reported numbers were true, Madoff would have been purchasing nearly the entire available options market. And yet, there were no records of such trades. No broker remembered executing them. No financial institution confirmed transactions of that magnitude. It was as if the investments simply did not exist. Faced with these inconsistencies, Markopoulos began considering two possibilities. The first was that Madoff was somehow operating with massive amounts of insider information. That alone would have been a huge scandal. But the second possibility was even worse, that the entire operation was a giant Ponzi scheme. At first, the idea seemed absurd. How could a fraud of that size exist at the center of Wall Street, involving billions of dollars, without anyone noticing? But the more he analyzed the numbers, the clearer the conclusion became. For Markopoulos, the answer was obvious. It was fraud, and not a small one. Potentially the largest financial fraud in history. Convinced he had discovered something enormous, he decided to bring his findings to the authorities. In 2000, Markopoulos contacted the U.S. Securities and Exchange Commission, the agency responsible for regulating financial markets in the United States. He presented a series of technical arguments explaining why Madoff's results were mathematically impossible. But there was a problem. Markopoulos did not have definitive proof. He had calculations, hypotheses, and statistical inconsistencies. But he did not have direct access to Madoff's internal records. For the SEC, the case looked more like a suspicion than a concrete accusation. The complaint did not move forward, but Markopoulos did not give up. Over the following years, he continued investigating on his own. He spoke with traders. He talked to fund managers. He tried to find any evidence that Madoff was actually executing the trades he claimed to make. And repeatedly, he encountered the same response. No one had ever seen those transactions happen. Over time, Markopoulos began to realize something even more troubling. Inside Wall Street, many people already suspected something about Madoff did not add up, but almost no one wanted to talk about it publicly. The reason was simple. If Madoff truly was running a fraud, then many respected financial institutions were helping direct client money to him. Investment funds, private banks, and wealth managers were earning fees by referring investors to Madoff. Questioning him could potentially expose an entire chain of financial interests, and no one wanted to open that Pandora's box. Still, Markopoulos kept pushing regulators to investigate. In 2005, he prepared a detailed 17-page report explaining exactly why he believed Bernie Madoff was operating a Ponzi scheme. The document carried a blunt and almost provocative title: "The world's largest hedge fund is a fraud." Once again, he sent the report to the SEC. Once again, he expected that action would finally be taken. But what happened next would become one of the most embarrassing episodes in the history of American financial regulation. The investigation opened by the SEC was superficial. The investigators involved did not possess the technical expertise necessary to fully understand Markopoulos's analysis. At the same time, Bernard Madoff remained an extremely respected figure inside the financial industry. He had served as chairman of NASDAQ. His name appeared on boards, committees, and industry events. For many regulators, it seemed unlikely that someone with that level of reputation could be running a massive fraud. and so another opportunity to stop the scheme was lost. Meanwhile, the system continued to grow. Billions of dollars kept flowing in. Investors continued receiving statements showing stable and apparently safe returns. The fraud remained invisible. But somewhere in Boston, one financial analyst kept repeating the same conclusion to anyone willing to listen. It could not last forever. Because Ponzi schemes share one unavoidable characteristic: they depend on trust. And when trust disappears, the entire structure collapses. The problem was that, at that moment, almost no one realized how large that structure had truly become. And almost no one imagined that it would take a global financial crisis to finally bring it down. Because when the money stops coming in, the truth eventually surfaces. For years, the system created by Bernie Madoff seemed almost indestructible. Investors received steady reports. Financial advisors continued recommending the fund. Private banks kept directing wealthy clients toward what appeared to be one of the most consistent strategies on Wall Street. Money kept flowing in, and as long as the flow of capital remained positive, the scheme worked perfectly. That was the core logic behind any Ponzi scheme. New money pays old investors. Reports show profits. Confidence grows. More money comes in. The cycle continues. But there is one external factor that no fraud operator can control: the behavior of the global economy. And in 2007, signs of instability began appearing inside the American financial system. For years, banks had issued mortgage loans to millions of people with low ability to repay. These loans became known as subprime mortgages. At the time, many banks believed the risks were limited. If a homeowner failed to pay the mortgage, the property could simply be sold again. The logic seemed safe, but there was a problem. These mortgages were not just sitting on bank balance sheets. They had been bundled together, transformed into complex financial products, and sold to investors around the world. Investment funds, insurance companies, international banks, and even governments had purchased these assets. And for a while, everything seemed to work. Housing prices kept rising, mortgage payments continued, investors received returns. But when the U.S. housing market began to slow down, the entire structure started to show weakness. In 2007, the first funds began reporting significant losses. By 2008, the situation had grown into something much larger. Banks began realizing that many of those assets were not worth what they had believed. Credit started to dry up. Financial institutions began distrusting one another. And then came the moment many economists consider the official trigger of the crisis. In September 2008, the investment bank Lehman Brothers declared bankruptcy. It was one of the oldest and most respected banks on Wall Street. Its collapse sent a clear message to the market. If an institution of that size could fail, any institution could fail. Panic spread rapidly. Investors began withdrawing money from funds. Companies started cutting costs. Banks restricted lending. Financial markets around the world entered free fall. It was the beginning of what is now known as the global financial crisis. Trillions of dollars in market value disappeared within months. But for Bernie Madoff, the real problem was not the falling stock market. It was the behavior of investors. During periods of crisis, investors do something predictable. They withdraw money. Investment funds began receiving massive redemption requests. Clients wanted liquidity. They wanted to turn investments into real cash. And that was exactly the kind of situation a Ponzi scheme cannot survive. For years, Madoff had used new money to pay older investors. But now, the flow had reversed. More money was leaving than entering. And this time, there were not enough new investors to sustain the system. By the end of 2008, it is estimated that Madoff's clients were attempting to withdraw around $7 billion. The problem was simple. That money did not exist For decades, much of the capital had been used to pay previous investors, fund Madoff's lifestyle, and maintain the illusion of success. What remained in the accounts was only a fraction of the total value clients believed they owned. For the first time in many years, the system began collapsing. Fake reports continued to be sent. But inside the company, some executives began realizing that something was deeply wrong. Meanwhile, Madoff desperately tried to find new sources of capital. He searched for new investors, attempted to raise money through international connections, tried creating new financial products. But at that moment, the global financial system was in survival mode. No one wanted to take new risks. No one wanted to make new investments. Money simply stopped moving. And when the flow stopped, the entire structure became exposed. In early December 2008, Bernie Madoff finally reached the unavoidable conclusion. The scheme was over. After decades operating in the shadows of the financial system, the fraud had finally reached its limit. But the way everything would end would still surprise many people, because the largest Ponzi scheme in history would not be discovered by regulators. Not by government investigations, not even by the analyst who had spent years trying to warn the world, Harry Markopolos. In the end, the fraud would be revealed in a far more unexpected way, inside Bernie Madoff's own family. And when the truth finally came out, the impact was far greater than anyone on Wall Street had imagined. Because when the numbers were carefully analyzed, investigators discovered that it was not just a few $1 billion that had disappeared. The real size of the scheme exceeded $65 billion, a number so large it completely redefined what the world understood as financial fraud. In early December 2008, reality finally caught up with Bernie Madoff. For decades, he had maintained a system built on trust, reputation, and numbers that were never truly verified. As long as money continued flowing in, the machine worked. But now the financial world was facing an unprecedented crisis, and investors were doing exactly what investors always do when fear takes over the market: asking for their money back. Redemption requests began arriving in volumes the operation simply could not sustain. Billions of dollars were being requested at the same time. The problem was brutally simple. That money did not exist. For years, statements sent to clients showed their accounts growing steadily. Many investors believed they had multiplied their wealth over decades. Some charities, universities, and foundations depended on those supposed gains to fund entire projects. But most of that money was nothing more than a number on a statement, a carefully constructed illusion. By early December, withdrawal requests had reached roughly $7 billion. Even if Madoff had wanted to pay, he could not. The structure that had supported the fraud for so long had finally reached its limit. For days, he tried to find a way out. He searched for new sources of capital. He tried convincing some investors to keep their funds invested. But at that moment, the global financial system was frozen. Banks were fighting to survive. Funds were being liquidated. No one was interested in sending money into a new investment strategy. The inflow had ended, and without inflow, a Ponzi scheme collapses. That was when Bernie Madoff made a decision that would change the course of the story. On the night of December 10, 2008, he called his two sons, Mark Madoff and Andrew Madoff, for a meeting in his Manhattan apartment. Both of them worked in the legitimate brokerage division of the family firm. They understood the business. They knew how the company operated, but according to their later accounts, they had no knowledge of the fraudulent scheme running inside the investment advisory division. During that conversation, Bernie finally said the words that would end decades of deception. He explained that the investment business was, in fact, one big lie, a Ponzi scheme. According to Madoff himself, the total losses at that moment were around $50 billion. Later estimates would suggest that the real figure when including the fictitious profits shown to investors, exceeded $65 billion. His sons were stunned. For years, the family name had been associated with credibility and prestige inside the financial industry. Now they were hearing that everything had been built on top of a massive fraud. And there was more. Madoff explained that he intended to distribute around $200 million in bonuses to company employees just days before turning himself in to authorities. In practice, it would be one final attempt to remove the remaining money from the operation before the official collapse. For Mark and Andrew, that crossed an unacceptable line. They immediately realized that if they participated in that decision, they could be considered accomplices. The next morning, the two men made a difficult decision. They contacted a lawyer and reported what they had heard. Within hours, authorities were notified. On the morning of December 11, 2008, agents from the Federal Bureau of Investigation arrived at Bernie Madoff's apartment in Manhattan. The conversation was direct. The agents asked if there was any truth to the fraud allegations. Madoff's response was simple. He said he was running a giant Ponzi scheme. No hesitation, no attempt to deny it, no resistance. At that moment, one of the largest financial scandals in modern history had officially been revealed. The news spread quickly, first across Wall Street, then through American media, and within hours, across the entire world. Investors began realizing something was terribly wrong. Phone calls started happening everywhere. Financial advisors tried to understand what was unfolding. Institutions that had directed clients to the fund began investigating their own exposure. Gradually, the scale of the disaster began to emerge. Pension funds had lost billions. Universities had lost significant portions of their endowments. Charitable organizations had lost almost all the capital that supported their operations. But perhaps the most devastating impact was felt by individual investors, people who had trusted the company with their life savings. Some had invested their retirement funds. Others had placed family wealth accumulated over generations. Many believed they were investing in a conservative and stable strategy. Instead, they had been financing a fraudulent system that had existed for decades. As investigators began analyzing the company's records, the scale of the fraud became even more astonishing. They discovered that in many cases, the reported investments had never existed. The trades that supposedly generated consistent profits had never been executed. Much of the trading activity shown on account statements was entirely fictitious. Everything had been created inside the firm itself: spreadsheets, reports, fake confirmations, detailed statements, an entire infrastructure designed to simulate a real investment business. For years, thousands of people had believed those numbers. And for years, almost no one had deeply questioned how those returns were actually generated. Now, with the system exposed, questions began emerging everywhere. How could something this large exist for so long? How did regulators fail to detect it? How did sophisticated institutions trust an operation that provided so little transparency? And perhaps the most unsettling question of all, if the financial system failed to detect something of this magnitude, how many other frauds could still exist without being discovered? As the scandal exploded across global headlines, Madoff was initially placed under house arrest after posting a $10 million bail. But that situation didn't last long. In March 2009, he appeared in federal court and pleaded guilty. No deal, no negotiation. He admitted to 11 federal crimes, including fraud, money laundering, perjury, and falsifying records. On June 29, 2009, federal judge Denny Chin announced the sentence: the maximum penalty allowed by law, 150 years in prison. At the time, Madoff was 71 years old. In practice, it was a life sentence. During his final statement in court, he apologized to the victims. But for many investors, it meant nothing. The damage had already been done. From that moment on, one of the largest financial recovery operations in history began. A court-appointed trustee was assigned to try to recover the lost money. For years, he He traced assets around the world, seized properties, and sued individuals and institutions that had received profits from the scheme. Luxury homes, yachts, bank accounts, everything was confiscated. Some of Madoff's most famous properties were sold in federal auctions: his Manhattan penthouse, his home in Palm Beach, his vacation house in Montauk. The recovered money slowly began returning to victims. Over the years, billions of dollars were recovered through lawsuits and asset liquidations. But for many investors, the impact was irreversible. The scandal also destroyed Madoff's own family. 2 years after his arrest, in 2010, his son Mark was found dead in his apartment in New York. He had taken his own life. The tragedy deeply marked the legacy of the fraud. His other son, Andrew, battled cancer for years before dying in 2014. Meanwhile, Madoff spent the rest of his life in a federal prison in the United States. In his final years, his health deteriorated. He suffered from chronic kidney failure and other medical complications. On April 14, 2021, Bernie Madoff died inside a federal prison. He was 82 years old. To this day, the case continues to be studied by economists, regulators, and financial historians, not only because of the size of the fraud, but because of the question that still doesn't have a simple answer. How did a scheme of this magnitude exist for decades in the very heart of Wall Street? How did so many experts, regulators, and institutions fail to see what was happening? The answer may lie in a very simple factor: trust. Bernie Madoff built a reputation so powerful that very few people felt comfortable questioning him. And in the world of finance, when nobody questions the numbers, sometimes that's exactly where the biggest disaster is hiding.